Hello, my name is Robert Young. I'm one of the owners here at One-to-One Strategies, and I want to welcome you to our 2022 Geopolitical Update. I am going to be joined by my partners, Gavin Jensen and Adam Carlett. So before we get started, I'm going to turn it over to, go ahead, Larry.
Thanks, Robert. My name is Larry Brody, and I'm the Director of Operations here at One-to-One Wealth Strategies. And I'd like to welcome you as well to our presentation on the current geopolitical climate and the effect that it's having on the markets. This is going to be an overview of the live client education event that we held last week via Zoom, but it's going to allow us to pare things down and be a lot more direct and to the point. The impetus for the original presentation came from several overlapping U.S. and global current events that I'll cover in just a minute, and how they're affecting the economy, more specifically, how they're affecting your retirement portfolio. Before we get started, we do have to go through our disclosures. So I just want to let everybody know that this presentation is intended for general information purposes only. It is not intended to provide any specific investment advice or recommendations. So understandably, we have received many phone calls and emails from clients in the past few weeks worried about how the current state of world events will affect their portfolios, especially in light of the recent market declines. Our main objective today is to ease the minds of our clients regarding their personal financial plans and portfolios through a long-term investment strategy. We'll do this by addressing three major points: the Russia-Ukraine conflict, high inflation, and the Fed interest rate hikes. I'll now turn it over to Robert, and he will start with a brief update on today's markets.
Great, thank you very much. I appreciate it, Larry. Let's go ahead and start with the current state of the U.S. markets. So as the close of markets on Monday, March 28th, as you can see on here, the Dow Jones Industrial was down about 3.8%. It stood at about 34,955. You see the S&P 500 was down about 4%, standing at 4575. And the NASDAQ 100 was down about 8.25%, closing at 14,354. So essentially, like I said, each of the indexes was down, but let's see what it looked like from a dollar standpoint, because a lot of people look at percentages and it doesn't give them a real good idea of what it means in dollars. So if we look at the Dow Jones Industrial Average, if you invested $10,000 on January 1st, by March 28th, it'd be worth $9,620. The same $10,000 invested in the S&P 500 is worth $9,600, and the NASDAQ 100 index would be down to $9,175. So it gives you an idea of what the real dollars look like on here. The next thing that we're getting a lot of questions on is, how is this whole thing with Russia and Ukraine affecting us? So without going into a history lesson on Russian-Ukrainian diplomatic relations, it's important to know that while the invasion began on February 24th, the conflict started long before that. The two countries have had a long and complicated history, as Ukraine has wanted to align itself more with the West. Russia has wanted to keep its sights on keeping control over the former Soviet bloc country. And these anxieties have really just been amplified by Russia's tensions with NATO and Ukraine's interest in joining NATO. But what effect will the conflict have on markets? That's what everybody wants to know. Well, no one knows what absolutely for sure, but a February 23rd, 2022 report from Economics Research Unit at the Goldman Sachs Group found that it poses only limited direct effects to the US economy, but higher risks for Europe. This is primarily because both Russia and Ukraine are much smaller trade partners with the US than they are with Europe, accounting for less than 1% of US total imports and exports. The US, remember, is a net exporter of natural gas, and we only imported about 3.5% of our oil from Russia in 2021, according to Forbes. Well, almost 2/3 of all US imported oil comes from Canada and Mexico. So The next thing on here that we're getting a lot of questions about, and we want to address this, is inflation. So the definition of inflation is basically a sustained increase in prices of goods and services over time. So we generally view high inflation as a bad thing and low inflation as a good thing, as most people know, but it's much more complicated than that. So remember, inflation erodes your purchasing power, but since it lowers the value of cash, it encourages consumer spending on things that are slower to lose value. For example, if you buried a $100 bill in 1980 and you dug it up today, it's a $100 bill. The problem is the purchasing power $30 in today's terms. However, let's say that you invested $100 in the S&P 500, it would be worth over $4,000 today. So why are we seeing, currently seeing the sharpest year-over-year inflation jump in 4 decades? In simplest terms, when the pandemic hit and lockdowns began, 22 million jobs were lost in the US. It sent our economic output into a tailspin. It ignited a recession. Then, fueled by large sums of government aid and emergency intervention by the Fed, interest rates were slashed. The rollout of vaccines emboldened consumers to return to normal, quote unquote. In December alone, 10.9 million of those pandemic era jobs lost were now back on the books. And businesses were struggling to keep up with the demand for supplies and workers, causing global supply chains to bog down. The ensuing high demand for low supply drove costs up, and companies passed these costs on to consumers. Basically, the Fed anticipated a much slower economic recovery than what actually happened. And that is not an indictment on any individual, any government entity, or political party. Okay, this is strictly about how it affects portfolios and the economics here. This is an incredibly precarious tightrope to watch, regardless of who is in the which political party is in charge. So those of you that have been with us for a while have seen this slide. So I want you to take a look at this. All of you have seen some form of this slide. And basically inflation, whether it's high or whether it's low, it's always going to be with us. The question is simply, do you have a plan to outpace inflation in preparation for and during your retirement years? So with that, I am going to turn it over to Adam, and he is going to talk a little bit about the Fed and what's going on over there. So Adam, it's all yours.
Thank you, Robert. I appreciate it. And inflation is definitely a big thing right now, and we're going to talk about what the government is doing to combat high inflation. We just had year-over-year inflation at the end of February 2022 at 7.9%, its highest since January of 1982. So the goal of the Fed is to keep inflation at 2%. And although it will probably be a while before we get there, we are seeing the supply chain logjam starting to unclog slightly. The Fed has stopped purchasing as much money in bonds. They were purchasing billions of dollars of bonds each month. That has slowed down. There's no more COVID economic relief checks being issued. And interest rates are scheduled to increase bi-monthly or quarterly. Right now, it just happened in March where the Fed funds rate was increased by 25 basis points, or 1/4 of 1%, to help cool off the economy. They can increase those. They're saying maybe by 50 basis points in May. We'll see what they do. But they just did 25 basis points here in March, and that is to hopefully help continue to offset some of these inflation concerns. We'll spend the next part of the presentation talking about the current geopolitical climate and the state of our economy, is what we started with, and we'll finish up with some long-term market numbers illustrating the importance of having a long-term plan. You see us stress that a lot if you work with us and our advisors. I think it's very important to have a long-term plan for your specific needs, your unique financial needs, and when you need access to your investments and your money. So if you were investing in 2020, you definitely saw a huge market downturn with COVID. Everyone knew, everyone heard about the pandemic, obviously. It was very much in full swing. And then we saw from January 1st to March 23rd, 2020, a really big drop in the stock market and a very quick drop. We saw the Dow Jones drop by almost 35%, the S&P 500 almost 31%, and the NASDAQ over 23.5% in a very short time. So dollar-wise, if you had $10,000, we saw a big drop, right? If you were invested 100% fully in the Dow, which we would never have you 100% in anything, but the Dow was, you would have been down to almost $6,500. In the S&P 500, almost $6,900, and the NASDAQ just over $7,600 from a dollar standpoint if you started with $10,000 on January 1st. Now, if you were able to somehow time it perfect, and you got in exactly on March 23rd, 2020, which was the bottom of the stock market drop from the COVID drop, as we call it, then the market went up drastically throughout the rest of the year of 2020, from March 23rd to the end of 2020. We saw the Dow increase by 64% from the bottom, the S&P 500 over 67%, and the NASDAQ almost 88% from its low on March 23rd. And from dollar-wise, what that would have done for you, that same $10,000 that had started in March 23rd would have been worth over $16,400 in the Dow, almost $16,800 in the S&P 500, and over $18,700 in the NASDAQ, which is obviously a huge increase. But if you would have started on January 1, because we're not expecting anyone to time it exactly perfect, right? And we want you to stay invested for the long term and for your time horizons and your needs. If you started on January 1, you still were up over 7% in the Dow, 16% in the S&P 500, and 43% in the NASDAQ. So you end up still having a great year in 2020, even with the pandemic in such uncertain times. You would have made, again, almost $1,000 in the Dow, over $1,600 in the S&P 500, and over $4,300 in the NASDAQ. So still had a great year in 2020 with all that uncertainty. But we want you to look more long-term for your needs, typically, especially if you're preparing for retirement, or even if you're just starting retirement, right? If you look all the way back from, this starts in January of 92 is actually when the numbers start here. You made over 1,000% in the S&P 500 if you stayed invested. There was a lot of economic uncertainty through all these different times, and Gavin will go over some of that later. But over 1,000% was made during that time horizon in just the S&P 500, almost 2,600% in the NASDAQ, and almost 940% in the Dow Jones Industrial Average. Dollar-wise, that $10,000 we talked about, again, being long-term, would be worth over $101,000 in the S&P 500. It's amazing what your money can do for you. The Dow, over $93,000, and the NASDAQ, almost $260,000 on just that $10,000 investment in 1992. So we know one thing, the market will always go up and down. Without uncertainty, we know that. If you could predict it exactly perfect, you'd buy an island and be multi-billionaire, right? But again, invest for your needs and your time horizon. There will be a lot of different things that affect your portfolio along the way, but make sure you have a short and long-term plan, and we're here to help you out with that. Gavin's going to talk to you more about the emotions of investing.
Thanks, Adam. Great job to you as well, Robert. Many investors, when it comes to, and if you could look at this chart, not only is the optimism and the elation, the nervousness and the fear and the optimism on the other side, but also think about this as the market. And generally, when we start to see those dips from nervousness to fear, it are the volatile times within the market when people tend to think more with their heart as opposed to with their head. They get stuck in an optimism, elation, nervousness, fear loop that often causes them to sell low and buy high, the exact opposite of what it is that we want to strive for. While some short-term investment strategies are prudent in certain circumstances, history shows that staying patient and sticking with your long-term plan is the smart play. That being said, past performance is no guarantee of future success. We've shown this paragraph many times in the past to illustrate various points, and it fits perfectly here too. In a 52-year period shown here from 1970 through 2022, including COVID-19, There are 58 crisis events highlighted. Yet if you invested $10,000 with the S&P in 1970, it'd be worth more than 2.1 million at the beginning of 2022. We want our clients to understand the economy and the markets do not move in lockstep. The market prices in future potential movements of company stock depending on what investors perceive will happen to them. The market can move in an upward direction during a downward or downturn in the economy and adversely move downward in a strong economy. The next chart shows all of the S&P 500 ups and downs using a 10% threshold for downturns from 1926 through 2020. You can see that every 10+% downturn has been followed by a sizable upturn. Now, there are two things that Adam mentioned to you earlier that we know for sure about the market. The markets will go up and the markets will go down. By how much and when, we don't know. And as this chart illustrates, since 1926, there have been 71 years where the S&P 500 finished the year on a positive note versus only 25 years when it ended on a negative note. And the average up years were plus 21.3% versus the average down year at negative 13.2%. Now, going back to the slide that talked about emotional investing, this chart shows what the return on a $10,000 investment would have been if you panicked and got out of the markets for any of the best days over the last 40 years. And as you can see, is if you stayed in, you had over 1.184 million, whereas if you missed 50 of the best days, you were reduced from that 1.18 million down to less than, well, 85,000. We'll call it 84,580. To have a better investment experience, people should focus on the things they can control. It starts with an advisor creating an investment plan based on market principles, informed by financial science, and tailored to a client's specific needs and goals. Along the way, an advisor can help clients focus on actions that add investment value, such as managing expenses, portfolio turnover while maintaining broad diversification. Equally important, an advisor can provide knowledge and encouragement to help investors stay disciplined through various market conditions. And as we start to finish, I'd like to finish with a quote from Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. Therefore, once again, as you heard from both Adam and Robert, we focus on the long term. We feel that that's where the value is, and we feel that that's where the patient ones will be. With that, I'll pass it back to Larry to close up.
Thanks, Gavin. Good job as well. We hope that you found the information in the presentation reassuring. Again, that was our goal for today, to make you feel more confident in what's going on in your own portfolios in light of what's going on in the world today. It's our continuing goal to educate our clients, their families and friends on all financially related matters. And if you have any questions or would like any more information on anything that we covered, please feel free to call your advisor directly. They will be happy to address all of your questions and concerns. So until next time, on behalf of One-to-One Wealth Strategies, be safe, be healthy, and be educated. Thanks, everyone.